Hello everyone, and welcome to our Market Alert video for June 13, 2025. It is Friday the 13th, and we had a discussion. I thought Michael was from Friday the 3rd, but it turns out it's Jason that was in the Friday the 13th movies, so hopefully Jason has been put to bed and is not coming back after us. Thank you for watching. I am the CEO and founder of Retirement Planners of America. And we are a firm that specializes in, I think, the most wonderful thing in the world, and that is the creation of SCWPS. And if you don't know what SCWPS is the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we call them a SCWPS. We tell them to get out of here, go have fun, enjoy, and let us worry about all this boring financial stuff so that you don't have to. So thanks for watching. We have a lot to talk about. We got inflation data this week. We got jobs numbers this week. We had consumer confidence numbers this week. The trade deal with China apparently is moving along. So we got a lot to talk about. And we're going to frame it from the standpoint of what does that do to our stock portfolio, to our bond portfolio, to our retirement planning, and all of that. But before we get started on it, let me bring Jordan Roach, our Chief Investment Officer, into the fray. Jordan, good to see you.
Good to be back.
Yeah, it's good. You know, I have to tell you that I've been getting a lot of feedback from clients and others, and apparently these Market Alert videos are way better when I do them with you than when I do them by myself.
That can't be true.
It can't be, right? I mean, I'm actually offended by that. I mean, whoever said that, you know, I told people, hey, no, if it's only me, it's always better.
That's right. That's right. I understand that. And it probably was. That's right.
So I have some important news to share.
Okay.
My middle daughter, who lives in Brooklyn, New York, is within hours, as we record this, to give birth. And actually, if she, when she does, it'll be our third grandchild.
Boy or girl?
It's a girl.
Okay. And the others are boys.
Yeah, I got two boys,
okay.
and I have a 3.5-year-old boy and I guess he's 4-month-old boy as well, and now a little girl. And my daughter, her middle name of my granddaughter is Lily, which is my mother's name.
Oh, that's lovely.
So when I was talking to my daughter, I was like, that is so nice. You know, she has a
great.
Connection to my mom, and that's always wonderful.
That's neat.
You have some earth-shattering news as well when it comes to that, right?
I have a 2-year-old, almost 3-year-old, and this last week we got out of diapers.
Diapers.
We've done it 4 times.
This is our free at last. Glory, hallelujah.
This is the best. It's the best. So not as good as your news, but big in our world. That's right.
Hey, I remember when we were out of diapers. That was a big moment.
Yes.
Yeah. So congratulations on that. Although my news is bigger than yours, just so you know.
Yeah, okay.
So let's talk about the things that happened, right? So we had inflation went down. And this is despite the tariffs. I thought the tariffs were going to create all kinds of inflation.
Impossible.
And it was going to be, the end of the world. What happened there?
Yeah, this is interesting. Now, again, we say we're fairly early because we have had tariffs in effect for a bit, and we've had, the businesses have known tariffs are coming for a bit and a chance to raise prices, but we have not seen that flow through to final prices. So that is good news.
Yeah, I mean, it's the third inflation print we've gotten since the...
Holding steady.
And the tariffs don't seem to be gone. And by the way, ladies and gentlemen, I encourage you to watch our podcast on tariffs. I think we did an absolutely phenomenal job, if I do say so myself, and I do, explaining how tariffs work, how we collect the money, what happens when tariffs come into the economy, are they inflationary or not? And in the podcast, we explain why, in many instances, tariffs are not inflationary. So I encourage you to watch it. I think you'll find it interesting. Okay, so that was inflation. So the Federal Reserve is super interested in what inflation is doing, right? Because that's like their primary mandate.
I think so. I mean, they say they have dual, which is effectively economy, job growth, and inflation, keeping that under control. I think this Fed looks at prior Feds and goes, inflation really is the top.
That's the
keeping
one
that
they
under control.
Are focused on.
I think so.
Right, and then there's another gauge, their favorite, which is the PPI, right? The producer price index.
Well, they look at PC. Yeah, PPI just came out.
Yeah.
On the producer side. So you have basically what are consumers experiencing, CPI numbers, PC numbers, and then you have PPI, which is what businesses are feeling as they're getting raw goods to make the things that we consume. And that came in pretty much right in line with expectations.
So there doesn't seem to be a lot of inflation in the system despite the tariffs. Who knew?
Impossible.
Okay, so they have a dual mandate. the Fed, right? And the second mandate is job growth, right? They want to keep jobs going, and we got numbers on that, and job growth was up. So,
again, I think for many, you go into a news outlet, read a paper, impossible, right? But so far, economy keeps marching along, jobs keep marching along, new claims on unemployment insurance kind of down, if you will. So right now the economy appears to be healthy, still on its footing.
that's good, because a lot of people were worried about how the tariffs would cause us to go into a recession, have high inflation, lose jobs, and all those things.
Absolutely.
And so far, it's early still, to be fair.
Yeah.
But so far, it doesn't seem that the tariffs are causing too much.
So far, that's right.
Yeah. Now, the other thing, let's stay with the Federal Reserve. So if they see that jobs are growing, inflation's coming down, most likely then they lower interest rates sometime this year, right?
You would think. I mean, I think the biggest holdup for them, in my view, would be, is inflation. They are looking at jobs, but I think far more important to them is inflation prints. And so, the expectations of what the Fed's going to do have been moving all around. But I think it would look more likely the Fed could start lowering interest rates at some point this year. Now, whether it's late next quarter, whether it's late this the fourth quarter, don't know. But it's looking now, they're getting a little bit of the ammo they probably need to go, okay, we're not worried about this rearing its head again.
Yeah, because, as we've talked about in our previous Market Alert videos, if I'm Jerome Powell, if I'm the chairman of the Federal Reserve, and the jury's out on what tariffs are going to do, are they going to be inflationary? And if so, I don't want to be lowering interest rates into an environment where inflation's going up. So if we continue to get these lowered or stable inflation prints, then that fear is off the table, and then there's no reason to wait anymore because jobs are holding and the economy seems to be doing fine.
Right, and especially with right now, and the economy is holding with rates being where they are.
Well,
so why
true too,
preemptively do that? So I think this seems to be good news.
Okay, and then we also had consumer confidence numbers in, and consumer confidence went up again.
Consumers like
that was all over the place. It's like the consumer can't make up their mind.
The consumer cannot. The consumers are reading their newspapers, staring at their screens, and they're all over the place with their emotions. But nonetheless, we'd rather consumers be confident than not.
Well, that's true. That's true. Given a choice, we want consumers to be confident.
That's right.
Because they're 70% of the consumption in our country. So they're the ones that drive everything.
Yes.
So we want them to be confident. We want them to have a job, and we want inflation to be coming down. And all three of those things are happening.
That's right. We want to feel like they're going to keep having a job. They can keep spending their money, so on and so forth. That's right.
And then, to add a little cherry on top, it appears that the big deal, right, when it comes to the tariffs and negotiations, all the others are not as important as the one with China. And that one seems to be, apparently they had this big meeting in London, a 2-day meeting, and came out of it. And it looks like the Chinese agreed to let us, to open up the spigot for rare earths, which we make magnets and other things with that are crucial to all of our digital and electronics.
Yes.
That's a very important thing. And in exchange, which kind of, I'm still kind of, it mystifies me a little bit, but they exchanged that for still allowing Chinese students to study at our universities.
That's an interesting one. Of all the levers they could pull, the negotiating tactics, say, I want that.
Yeah.
Maybe it's a little unsettling. I don't know.
I know. It kind of makes me feel like maybe there's some spying or some espionage or I don't know what. But boy, anyway.
But nonetheless, they got something done. That's good, probably.
So that's a good thing, alleviating some of the. So let's talk then about what this does for the stock market, and then we'll talk about the bond market, because with our clients, we have a blend of those depending on their portfolio. So let's start with stocks. What does all this bode for stocks?
Well, this largely would be good for stocks to feel like they could continue to march on towards an all-time high. We're roughly 2% from that. And that should actually be, for most people, more reason to be excited than scared. Right? That's a good thing.
Wait, a new all-time high?
Is usually a good thing, not a bad thing. It doesn't mean
Jordan,
stuff.
it's a new all-time high. I want to sell everything.
Well, yep, I would say we could do that, but generally speaking, that is not what you want to do towards all-time highs.
Okay.
Right. So we again, the markets right now are looking at a lot of things, and I think the good news is they're finally able to see through some of the darkness, some of the clouds, and say we can focus on job growth, we can focus on earnings growth, we can focus on all these other things in a more normalized stock market environment. And broadly, that would mean, for what we're seeing now for the next 3, 6, 9, 10 months, we see some daylight, which is a good thing.
Okay, so stocks, especially if the Fed lowers interest rates, stocks will love that.
Yes.
But certainly jobs, consumer confidence, inflation, those numbers are net positive for the stock market.
Yes.
So let's talk then about the bond market. As people who have watched our market alert videos know, when the Fed lowers interest rates, that's very good for bonds. Bonds tend to go up in that environment. So if the bias is towards the Fed lowering interest rates, that should be positive for bonds.
I think so. I mean, again, the bond market has been, and yields, interest rates have been very volatile, as they're trying to get a hold on inflation and deficits and all these things. But yes, if we think if the bond market thinks the Fed is going to lower interest rates, if the Fed does actually lower the interest rates, I think that should be good for bond prices.
Yeah.
For bond portfolios largely, and I would say in some respects, stocks actually might take in their lead from what bonds are saying, not the opposite.
Okay. So therefore, we should throw caution to the wind and assume that everything is perfect and hunky-dory, and we're going to see new all-time highs. The Fed's going to lower interest rates, bonds are going to sing, stocks are going to sing, and nothing can go wrong, right?
I would say, like always, the market is still wound up, still tense, always ready for that new thing that changes all this.
Yeah. I remember back in October, I think it was, of 2008, when suddenly people realized that Lehman was going under, and the stock market just crashed after that. So something came out of the blue. Now, fortunately, our strategy told us to get our clients out almost a year before that. So we avoided those big losses that occurred in 2008 and 2009. So we can't get overconfidence here because just because this set of data looks positive, it's the unknown that comes out of nowhere that can cause things. And that's why we think it's so important to have a strategy for investing when you are going for growth, when you're on offense, but also having a strategy to protect yourself when things go the other way.
Absolutely. It's rules-based. It's not driven by emotion and fear or the whys. It's a system that helps us just say this is off and we can make a decision off of it. So it's very helpful in this type of environment because, again, things can change quite a bit.
Yeah. And, for people that we want to work with, the ones who are within 5 years of their retirement or they're in the first 5 years of their retirement, if they're in that decade, taking a big loss like what happened in Y2K in 2008. And by the way, folks, don't think that because that was 17 or whatever years ago,
17.
that it can't happen again, okay? Because the farther you get from the last one, the closer you are to the new one.
Yeah, that's right.
Don't ever forget that.
That's right.
And so having a strategy to protect against that it's kind of like having a strategy to protect against hurricanes. You hope it doesn't hit you if you live on the coast, but you got to have a strategy to address it. Otherwise, you're out there, you're naked.
I think if your strategy is, I think the next 15 years are going to exactly mirror the last 15, you're skating on thin ice. I think that's probably right.
Yeah. So, ladies and gentlemen, that is our market alert video for this week. Hope you found it entertaining, informative. Certainly, we'd love to visit with you if you are so inclined. If you are in that demographic, if you're in that 10-year, we call it the most important decade of your financial life, then certainly go to our website. It's rpoa.com and visit with us, to watch our other podcasts. In fact, sign up to listen to our podcast. We had over 300,000 people, 300,000 downloads rather, over the last year, and we have a fantastic podcast on tariffs and why, in many cases, tariffs do not cause inflation. So click on the link. I think somewhere there's going to be a link, right, Paul, that they can click on. So you can watch that podcast. I think you'll find it very, very good. You did a great job in that podcast, by the way, Jordan. Well done. So, ladies and gentlemen, thanks for watching. Like and subscribe, and we'll talk soon.
Retirement planners of